Hey everyone, in today's video, we're going to be talking about how you can minimize RMDs, required minimum distributions, through a concept called asset location. No, we're not talking about asset allocation, but rather something called asset location. And so the idea behind this is we talk about a lot of different strategies that you can use to minimize RMD in your retirement. A strategy we're a big fan of that makes a lot of sense for a lot of retirees right now is Roth conversions. And so a lot of people think Roth conversions are the only ways that you can minimize RMDs. And that's simply not the case. In today's video, we're going to be talking about how you can use your retirement investing strategy using simple blocking and tackling, the very basics of your retirement investing strategy to help minimize RMDs. Now, before getting into the meat and potatoes about what asset location is and how you can use your retirement investment strategy to minimize RMDs, we've noticed in our YouTube analytics that 70% of the people that watch our content, we have a lot of viewers that watch our content, 70% of those viewers are not subscribed, meaning that they're relying on the YouTube algorithm to suggest our content to them, okay? And again, YouTube algorithm changes all the time. At certain points, they may no longer recommend our content for you. So if you're interested in getting more from your retirement assets, learning how you can use the assets you already have to propel your retirement forward, make sure you hit the subscribe button, hit the notification bell. You'll be notified of all future content that we release. We release content just like this each and every week. Okay, so let's get into it. Let's first talk about the problem. Okay, so we're big proponents that every retiree needs a forward-looking tax plan when they enter retirement. The reason being is because your tax situation will change throughout retirement. There's different tax hurdles that you won't face at some point in retirement that you will as you age, now face. A big one of those is RMDs. And so I took this graph from a person's forward-looking tax plan that we built for them. And what we'll see is that early in retirement, they're in some pretty optimal tax zones. Okay, they're in some pretty low tax brackets here. You'll see we have the 22%, the 24%, and the 32% illustrated here. These are tax brackets moving through time. You'll notice they go up through time. This is because of inflation. You'll notice certain dips, like this one right here, is because of the Tax Cuts and Jobs Act expiring in 2026. And so what we'll notice is a lot of people are in very tax beneficial times early in retirement. Okay, but once they turn 72, RMDs start, required minimum distributions. Basically, the government is going to force you to take money from your tax-deferred assets, whether you want to or not. Well, in this person's specific situation, they had some pretty large tax-deferred balances. And so what we would see in their situation, as soon as RMDs start, they basically exit this optimal tax planning environment and they start to enter some pretty high brackets. RMDs push them into the 22% bracket, into the 28% bracket, and even touching into this 33% bracket. You'll notice that the 22% bracket after the Tax Cuts and Jobs Act is turning into the 25%. The 24% is turning into the 28%. The 32% is lowering and turning into the 33%. So you're going to see the 33% bracket happen that much sooner. And so again, as we see in this person's situation, RMDs are going to be a real problem. And we see this continually with retirees, not being able to accurately assess RMDs. And this is why you need a forward-looking tax plan to know that you're going to see this tax hurdle later into retirement. So we would ideally want to eliminate a lot of these RMDs greatly, minimizing these RMDs, getting them under control. Obviously, you can do this with things like Roth conversions, but I also want to talk about how you can use asset location within your investment strategy to minimize these RMDs. So what's the difference between asset allocation and asset location? Asset allocation is when you turn on at CNBC. Asset allocation is what they talk about 24/7. Okay, it's what you're going to invest in. And it seems like the financial media loves to argue about this until they turn blue in the face. Should you own 65% stocks or 64% stocks? Okay, and obviously asset allocation is important, but oftentimes I see something called asset location completely forgotten about. Okay, if asset allocation is what you're going to invest in, asset location is where you're going to invest with those assets. So you have different tax accounts with a tax deferred, a Roth account, a taxable account. Where are you going to hold those specific assets, and does it matter? The answer is yes, okay? So let's talk about some simple tax efficient blocking and tackling. Let's say somebody's going to invest 50% into stocks and 50% into bonds. And you can change this out. Really, they're investing 50% into a growth asset and 50% into a safe asset. Okay, now I'm not making any recommendations on what you should be investing in this video right now. I'm talking about the asset location. So we're just using these as examples here. Now, most everybody has a traditional IRA and a Roth IRA. Now, each of these carry a different tax consequence if we think about it. So your traditional IRA, this is money that you received a tax break when you invested in this account. But at some point in the future, when you withdraw money from this account, you're going to owe taxes. So it's as if Uncle Sam owns a portion of this account. Okay, the traditional IRA, you're also going to see RMDs. They're subject to RMDs. At age 72, you're going to be forced to take money from that account whether you want to or not. A Roth IRA, however, you've already paid taxes on the money that's in that account. That Roth IRA, regardless of how big it grows in the future, will be tax-free. Okay, so each of these accounts carry a different tax status. So if we're investing 50% into stocks and 50% into bonds, here's what I see time in and time out. How do most people asset locate? They take 50% of the stocks and 50% of the bonds and they put them equally in each account. And intuitively, this makes sense. Again, if we want to be invested 50-50, we want to be invested 50-50 in each account, right? We want to see that growth happen in the same way in each of those accounts. We want that growth to track the same way. And that's not at all what we want. Again, because if we're thinking tax first, we know, just simplistically thinking, stocks, we invest in stocks for growth. Okay, now we take some risk with investing in stocks, but over the long term, we expect stocks to greatly outperform bonds, be our best growth asset. Okay, we invest in bonds for safety. And by earning that safety, we accept a lower, slower growth asset. Okay, so again, if we're thinking about this from a tax-first perspective, how should we asset locate? Well, again, depending on how the numbers shake out, how much you have in traditional IRA and how much you have in Roth, we should be putting all of these slower growth assets in the traditional IRA. Because again, remember, this is money that is eventually going to be taxed. So we want that account to grow as slow as possible. It will help minimize RMDs going forward in the future. Your RMDs are all based off that account balance. So the slower, lower growing account, basically if that traditional IRA grows slower and grows to be smaller in the future, again, we're still 50% stocks, 50% bonds, but those RMDs are going to be lower. We still have the safety in our account. Okay, the overall investments aren't changing. We're still staying 50-50, but we're changing the location of each of those investments. With the Roth IRA, we want all of the higher growing assets in that Roth IRA because we want that Roth IRA to grow as big as possible. Okay, and again, that's going to happen with that growth asset. Sure, there's going to be times where we experience a 2008 or a COVID downturn, and we're going to see the value of that Roth IRA dip. But over the long term, we expect that to greatly outperform, and we want that Roth IRA relative to that traditional IRA growing as large as possible. So again, think tax first. With everything in retirement, you should be thinking tax first. Let's go through a few examples here. I'm not going to go through 30 examples to try to mimic every viewer that may be watching this video, but let's go through 2 quick examples and show the impact of what this coordination can be. And I know there's a lot of numbers on the screen. I'll explain what they all mean. In the bottom right-hand corner here, if you're looking for what I'm using as assumptions, you can find that in that right-hand corner here. But let's take an example of a retiree. At the beginning of retirement, they have $750,000 in assets. $275,000 of that is in Roth, meaning the rest of that is in traditional IRA. Okay, and they're going to invest 50% into stocks, 50% into bonds. So let's say that they don't location coordinate their assets, meaning they're going to put 50% of stocks, 50% of bonds in each of these accounts. So a non-coordinated portfolio, and again, just for simplistic reasons, I'm not taking withdrawals from this. You're going to see some pretty large balances here. Notice that this is because we're growing this retiree's assets over a 30-year time period. So these overall balances are going to get fairly large through these examples. But this $750,000 in a non-coordinated portfolio grows to $3.48 million. Okay, and this is in after-tax dollars, meaning we're taking that traditional IRA and we're discounting it for taxes because obviously we know taxes need to come out. Versus what happens if we location coordinate that portfolio, meaning we put these stocks in the right account, we put the bonds in the right account. Now, obviously, they have much more in traditional IRA assets than they do in Roth. So even though we're putting all of the stocks in the Roth, we're still going to have some stocks in the traditional IRA there, okay? Nonetheless, though, this coordinated portfolio grows to $3.67 million. So what we see, no performance difference. Okay, we're not changing the allocation. We're staying 50% stocks, 50% bonds as we move through time. And there's no performance difference. And yet we see $191,000 after-tax improvement by coordinating this person's portfolio. Let's go through an example number 2. Okay, example number 2, we're using a retiree with $1.3 million in assets, $300,000 in Roth. So they have a little bit more in traditional IRA assets, and they're going to be investing in a very common 60% stocks, 40% bond portfolio. And so again, in a non-coordinated portfolio, looking at this person's situation through 30 years, okay, we see this $1.3 million grows to about $9 million. Again, non-coordinated, meaning they're putting 60% stocks, 40% bonds in each of these accounts and keeping it equal throughout. With the coordinated portfolio, they're putting the right assets in the right accounts. They're thinking tax first, as we all should be doing. And so with this coordinated portfolio, we see this person's assets, total value throughout their retirement, grow from $1.3 million to $9.5 million in after-tax dollars, which again, no performance difference. We're not changing the allocation. Everything is staying the same from an investment standpoint. But yet in after-tax dollars, we see a $500,000 improvement. Okay, and you're going to see this consistently, no matter how we change up the numbers. You're going to see this asset location add some significant value to your situation. Again, because you're thinking tax first, you're putting the right accounts or right assets in the right accounts. Okay, we want these after-tax accounts to grow as large as possible. Okay, that's why we're thinking asset location first. So let's go through a couple more things that you're going to want to think about. What about the third tax bucket? So again, we've been talking primarily about tax-deferred accounts and tax-free accounts, Roth IRAs. So a lot of people will view a taxable account. We have a lot of different trainings on these accounts. I'll link to them in the upper right-hand corner. A taxable account, a non-qualified account, a brokerage account, a joint account. They're called a lot of different things. A lot of people view these as a leaky bucket because anytime you make a tax change within these accounts, anytime you have a fixed income investment in these accounts, you're forced to pay taxes on a continual basis. Well, there's ways that you can patch that account. Again, I'll link to some videos in the upper right-hand corner if you're interested in how to make that a more tax-efficient account. But overall, when we're talking about asset location, the overall message applies equally. Okay, so basically with that tax-free account, we still want the growth in that tax-free account. We want that account to grow as big as possible. That's your most tax preference account amongst these 3 accounts. Second, though, we want your taxable account to still have growth if there's still growth left in your allocation. Again, the reason being is because we don't want to put fixed income within that account because that's going to force you to pay taxes on that money each and every year. That can be a very tax preference account if we plug the leaky bucket. So again, we want growth allocated to your taxable account. And then finally, tax deferred, we still want the safety in that tax deferred account. Again, that's going to be fully taxable when you pull money from that account. You're going to owe RMDs as well on that account. So that is the account where we want to minimize the most, put the safety in that tax deferred account. This also matches up with most people's optimal withdrawal strategy. Right now, most people should be pulling from this tax deferred account unless they're trying to avoid certain tax hurdles like earning an Obamacare subsidy. But otherwise, they should be pulling from this tax deferred account anyways. We're in some optimal tax environments. Taxes are going up in the future because of the Tax Cuts and Jobs Act. So you want to be pulling from this account. So this matches up, this tax location idea matches up with most people's withdrawal strategy, or optimal withdrawal strategy, I should say. Now, there are some additional factors you should consider. So some retirees that are watching this might be looking at this going, okay, I have $1.5 million in traditional IRA accounts and only $100,000 in Roth accounts. Well, many retirees, if they're planning optimally for tax for future tax-efficient income, should be doing some conversions. And so as they're performing some of those conversions, they're going to see their Roth balances grow. And so this idea of tax location investing will become more important as they move forward into the future. It might not be as an important idea of right now, but as they're performing those conversions, it will become that much more important. The other thing to note is some retirees will need safety in their Roth account. So that will change some of this location investing a little bit. If you're a retiree that's trying to earn an Obamacare subsidy and you're trying to pull income from a non-reportable asset, okay, you're going to need safety in that Roth account to be able to pull from that Roth account. So you may need to have a slight safe allocation if your withdrawal strategy calls for it within that Roth account. The other thing to note, though, is we use some fairly simplistic examples as we went through this presentation so far. As you add complexity, so for instance, if you come into our office, we'll show you the actual benefit given your situation of asset location investing. Okay, and we'll show you right inside your plan what that benefit will be. So by adding complexity, what we've noticed is it actually widens the performance gap. So again, we stayed fairly simplistic with our examples, if we would add additional complexity on this, we'd actually see that performance gap between those examples actually widen even more between a coordinated and non-coordinated portfolio. The reason being, as we add withdrawals, again, it will actually widen that gap. Okay, if we accurately estimate marginal tax rates, I just assumed a static tax rate in these simplistic examples. If we're actually accurately estimating marginal tax rates for what an RMD will cost you for different tax hurdles like the Social Security tax torpedo or capital gains bump zone, again, we'll see that tax savings rise even further. And then again, as we simulate growth rates through time, we'll see that rise as well. An important message as well, if RMDs are going to be an issue for your situation, what I would caution you to do is not simply try to avoid RMDs by just putting your full tax deferred accounts in cash because you don't want growth, because that'll just worsen that RMD situation. In a way, that's kind of trading growth for, you're kind of stepping over dollars to pick up pennies in a way. So again, I would urge people to still stick with an investment strategy, still grow those accounts. We still want growth even if there's going to be a tax liability, but do other things like tax location investing in order to minimize those RMDs. Use Roth Conversions in order to minimize those RMDs. So hopefully this was informational. Okay, always remember, this is a perfect example in this video. You don't need more money, you need a better plan. You need to use things like tax location investing in order to improve your after-tax wealth. Okay, if you have any questions about this strategy or any variations, let us know in the comments below. We love to hear your feedback. Again, always remember, you don't need more money, you need a better plan. Hopefully this was informational. If you like this video, don't forget to hit the subscribe button, hit the notification bell so you'll be notified of future videos that we release. Thanks for watching today. We'll see you in the next video. Thanks, bye.